4 days ago, the silver market did what it was never supposed to do. It broke through $70, punched past 72, and kept climbing like the brakes were cut. Today, silver is trading in the mid-70s, and the system behind it looks like it just found the edge of the map. This is not a rally. This is not volatility. This is the market stress testing itself in public, because the headline is not the price. The headline is delivery. The headline is who can't find the metal to back the promise. The headline is a paper market staring at the one thing it cannot manufacture, atoms. For years, a cluster of financial giants treated silver like a toy. They didn't sell metal, they sold promises. They sold futures, swaps, synthetic exposure, obligations dressed up as inventory. The playbook was simple. Push the price down with paper. Trigger fear. Buy back cheaper. Repeat. It worked because nobody asked for delivery. Digits are easy. Bars are difficult. And for a decade, nobody wanted difficult. Until now, this month, that changed. Buyers stopped accepting cash and started requesting metal. Not settlement. Not substitution. Delivery. The real thing. And when enough claims tried to become bars, the market behaved like a bank where everyone asked to withdraw cash at once. A system is solvent until enough people check. A futures market functions until enough contracts stand for delivery. Silver just experienced its first real withdrawal line. The move wasn't polite. It wasn't steady or gradual. It went vertical. A vertical move compresses time. It forces action. It forces margin. It forces the question, can you actually deliver what you promised? Shorting silver only works when silver is quiet. But right now, price is not quiet. Price is awake. And when price is awake, losses don't show up on paper. They show up as phone calls. Post more capital. Add collateral. Or we liquidate you. Now, imagine those short positions aren't a retail gambler with a margin account. Imagine they are institutions with exposure measured in hundreds of millions of ounces. At that scale, every $1 move is not annoying. It is fatal. $5 is a wound. $10 is a crisis. A vertical spike is a funeral. And the escape hatch isn't simple. In stocks, you can always buy back shares. In silver, you might be trying to buy something that isn't on the shelf. Because this market isn't one market. It's two universes pretending to be one. The first universe is paper, expandable, unlimited, typed into existence. The second universe is physical, bars, coins, stock, refined metal that moves slowly, expensively, reluctantly. Paper can be printed. Physical cannot. The paper world stretches. The physical world refuses. The system only works as long as most participants stay in the paper universe. It does not take a majority demanding delivery to break that balance. It takes a minority, a stubborn, informed minority that says, no cash, give me metal. At that moment, the market stops being a marketplace and starts being an audit. This is why inventories matter more than charts. Registered inventory is the number that counts, not total stock, not theoretical supply. Registered inventory is what can actually be delivered against a contract. When registered inventory falls, while open interest stays enormous, that is not a statistic. That is a countdown. A fractional reserve system works until belief breaks. A claim is as good as metal until someone asks to see it. We are entering the show-me era. The psychology is shifting. For years, the large players leaned on the price like gravity. They acted like the ceiling was permanent, like silver belonged below a certain number. Recently, that confidence cracked. Risk desks are adjusting. Hedge books are shifting. Shorts are unwinding, not dramatically, quietly. Quiet is always the first alarm. Meanwhile, the physical market isn't debating sentiment. It's paying premiums. Asia is paying up. Industrial buyers are locking supply. Refiners are sourcing ahead of time instead of just in time. Factories cannot negotiate conductivity. Defense cannot negotiate components. Power infrastructure cannot negotiate physics. Markets can pretend. Supply chains cannot. This leads to the wall directly in front of the system. If delivery pressure rises and registered inventory continues to shrink, the market will only have two choices. First, pay any price to find metal. Second, change the rules to avoid delivering metal. One is a panic. One is a confession. Neither is stability. And that is where part two begins. Not with a rally, with a reckoning. Because this is no longer about price, it is about credibility. And credibility, once questioned, does not walk back quietly. Now we move into the part nobody likes to think about. The part where price is no longer the battlefield, delivery is. Because once delivery becomes the point of contact, everything changes. The market stops being theoretical. It becomes physical. It becomes directional. It becomes survival. This is where silver stops trading like a commodity and starts behaving like a strategic resource. Because metal doesn't flow to the highest IQ. Metal flows to the highest urgency. Factories, militaries, power grids, infrastructure, entities that cannot function without conductivity, reliability, and components that do not have substitutes. When physical scarcity meets strategic priority, retail investors aren't competing with hedge funds anymore. They're competing with policy. If a government decides silver is critical, regulations shift, export rules change, flow gets redirected, and retail doesn't get a warning. They get whatever is left. This is where premiums matter. Premiums are not hype. Premiums are urgency expressed through price. If one region pays more, metal moves there. If one industry locks supply early, everyone else pays the late fee. If premiums persist, arbitrage doesn't fix it. Arbitrage drains inventory faster. The screen price is just a number. The street price is the truth. When those two prices separate, trust fractures. And once trust fractures, it does not reseal on command. Now let's talk about rule changes. Because a stress system doesn't ask for permission to protect itself. It acts quietly, quickly, without apology. Margin requirements rise. Position limits tighten. Delivery windows shorten. Cash settlement becomes optional, then preferred, then standard. At first it's temporary. Then it becomes precedent. Then it becomes normal. Every change will be framed as stability. But stability for whom? For the market, or for the liabilities hiding underneath it? You won't get that answer in the press release. You'll get it from behavior. If physical demand stays elevated while delivery capability shrinks, two outcomes sit on the table. Neither is comfortable. Outcome 1. Deliver the metal at any price. This forces price upward until demand drops or new supply is incentivized. That is not a rally. That is triage. Outcome 2. Redefine the promise. Cash settlement becomes the escape hatch. Contracts become exposure, not claims. Paper becomes a simulation of ownership instead of ownership itself. That is not stability. That is admission. If the market chooses admission, the benchmark loses meaning. Price discovery migrates. The real price moves off exchange. On-screen value becomes a reference, not a reality. This is where contagion enters the room. A commodity squeeze does not stay in its lane. Losses travel. Risk doesn't evaporate. It relocates. Institutions under pressure don't sell what's risky. They sell what's liquid. Equities, bonds, crypto, whatever raises cash the fastest. That is how a shortage in a single metal becomes stress in unrelated markets. Not because everything is broken, because someone needs money now. Liquidity is a lifeboat, and the crowded don't swim politely. So here are the signals that matter going forward. Watch registered inventory. If it keeps dropping, the fuse is still lit. Watch premiums between regions. If they keep widening, arbitrage isn't solving it, it's exposing it. Watch contract language. If settlement terms shift, credibility is shifting with them. Watch message tone. When risk rises, narratives get louder. You'll be told the danger is over. You'll be told the system is stable. You'll be told to relax. Always ask, who benefits if I believe that? This is no longer about bullish or bearish. This is about structural or unstable. It's about a market that built a skyscraper out of leverage and assumed no one would check the foundation. Silver is just the test case. The question is bigger. Are these contracts a claim on metal or a claim on confidence? Because confidence is abundant, metal is not. And if both start moving in opposite directions, the repricing will not be gentle. Everyone will sprint for substance at the same time, and there are not enough chairs. Keep your eyes on delivery, not headlines. On inventory, not opinions. On premiums, not promises. Because narratives argue, numbers confess, metal proves, and the proof is coming due.